Most business owners think they understand business finance until they face real cash challenges. The truth is, a company can look profitable on paper and still have very little money available in the bank. Cash often disappears in areas that many owners never pay attention to. That is why understanding these 10 business finance terms can completely change the way you manage your company. If you are a business owner who wants better financial control and smarter decision-making, these are concepts you need to understand. The first term is levered free cash flow. Levered free cash flow shows how much actual cash a business has left after covering operating expenses, capital investments, and debt payments. This number matters because accounting profit does not always equal available cash. A company can report strong earnings while having very little money left to spend. Imagine a small business in the United States generates $1 million in annual revenue. After paying operating costs and expenses, the company has $200,000 in operating cash remaining. During the year, it purchases new equipment for $50,000 and makes $100,000 in debt payments. The calculation is $200,000 minus $50,000 minus $100,000, leaving $50,000 in levered free cash flow. That $50,000 represents the flexible cash the business can actually use for future decisions, growth opportunities, or additional investments. The second term is credit line utilization. Credit line utilization measures how much of your available business credit you are currently using. Banks and lenders pay close attention to this number because it shows how dependent a company is on borrowed funds. For example, imagine your business has a $200,000 line of credit with a bank. If you are currently using $100,000 of that credit, your utilization rate is 50%. When businesses consistently use more than 70% of their available credit, lenders may see them as higher risk because it can indicate heavy reliance on borrowed money to manage daily operations. Smart business owners try to keep utilization under control by improving cash flow, collecting payments faster, and keeping more available credit open. High credit utilization can reduce borrowing power, negatively affect your business credit profile, and make it harder to qualify for better financing terms in the future. The third term is operating cash conversion cycle. The operating cash conversion cycle measures how long it takes for a business to turn inventory and sales into actual cash in the bank. It focuses on three important areas: how long inventory stays before being sold, how quickly customers pay their invoices, and how long the company takes to pay suppliers. For example, imagine a company keeps inventory for 30 days. Customers take 40 days to pay their invoices, and the business pays suppliers after 15 days. The calculation is 30 days plus 40 days minus 15 days, which creates a cash conversion cycle of 55 days. That means the business has to wait almost 2 months before the money from sales becomes available as cash. A shorter cash conversion cycle usually means a healthier business because money returns faster. A longer cycle can create financial pressure even when sales numbers look impressive. This is one of the reasons businesses can fail despite showing profits. The fourth term is accrued revenue and accrued liabilities. Accrued revenue happens when a business has already earned money but has not received the payment yet. Accrued liabilities happen when a company owes money for expenses that have already occurred but have not been paid. These concepts exist because accounting tracks when business activities happen, not only when cash moves in and out. For example, imagine a consulting company completes a $10,000 project in December, but the client does not pay until January. The company records that as accrued revenue because the income was earned before the cash arrived. On the other side, if the company receives $5,000 worth of marketing services in December but does not pay the invoice until January, that amount becomes an accrued liability. Many business owners overlook accrued items and end up with an inaccurate picture of their financial position. Accrual accounting helps reveal the true performance of a business by showing what has actually been earned and what obligations exist, even before cash changes hands. The fifth term is amortization of intangibles. Amortization of intangible assets is the process of spreading the cost of non-physical assets over their useful life. Intangible assets can include patents, software licenses, trademarks, and valuable business agreements. For example, if a company purchases a software license for $500,000 and expects to use it for 5 years, it does not record the entire $500,000 expense immediately. Instead, the cost is spread out over time, creating a $100,000 expense each year. This approach gives a more accurate view of yearly profitability because the cost is matched with the period when the asset provides value. Small business owners often encounter amortization when acquiring another company, purchasing technology, or investing in intellectual property. Although amortization does not involve an immediate cash payment, it still affects reported profits, taxes, and how investors evaluate a company's long-term earning potential. The sixth term is goodwill impairment. Goodwill appears when a company is purchased for more than the value of its identifiable assets. It represents the extra value connected to things like reputation, customer relationships, or brand strength. For example, imagine you acquire a company for $1 million, but the value of its physical and financial assets is only $700,000. The remaining $300,000 is recorded as goodwill. However, if the company later loses customers, market position, or brand value, that goodwill may no longer be worth the same amount. If a new valuation determines that goodwill is only worth $100,000, the business must record a $200,000 impairment expense. This reduces reported profit and signals that the acquisition did not maintain the expected value. Understanding goodwill impairment helps owners and investors recognize when a major purchase is no longer producing the results they expected. The seventh term is customer acquisition cost payback period. Customer acquisition cost payback period measures how long it takes for a business to recover the money spent to gain a new customer. For example, if a company spends $100 on advertising and marketing to acquire a customer, and that customer generates $25 in profit every month, the payback period is 4 months. After those first 4 months, the customer begins generating positive returns for the business. Companies with long payback periods often face cash pressure because they spend money up front and have to wait longer before recovering that investment. Understanding this metric helps business owners determine whether their marketing strategy is financially sustainable and whether their growth plans can support long-term success. Many small business owners overlook this metric and focus only on numbers like cost per lead or cost per customer. But customer acquisition cost payback period reveals whether your marketing strategy and growth plans are financially sustainable. A company can grow quickly while still running into cash problems if it spends too much upfront and takes too long to recover that investment. Understanding this metric helps business owners make smarter decisions about where to spend money and how aggressively they can scale. The eighth term is aging receivables. Aging receivables shows how long customers have owed your business money. It organizes unpaid invoices into different time periods, such as 0 to 30 days, 31 to 60 days, and longer periods. For example, imagine your business has $100,000 in outstanding receivables. If 60% of that amount has been unpaid for more than 60 days, that is a warning sign for your cash flow. Many small business owners celebrate making sales, but fail to pay enough attention to collecting the money they are already owed. The reality is that sales without collection do not create usable cash. Aging receivable reports help you understand whether customers are paying on time or whether your business is unintentionally providing interest-free financing to clients. Strong companies actively manage collections, follow up on overdue invoices, and sometimes offer early payment discounts to bring cash into the business faster instead of waiting months. The ninth term is covenant breach risk. When businesses take out loans, lenders often include financial requirements called covenants. These are conditions the company must maintain to keep the loan agreement in good standing. Covenant breach risk means a business is getting close to violating one of those requirements. For example, imagine a bank provides your company with a loan that requires a debt service coverage ratio above 1.2. If your business performance declines and that ratio falls to 1.08, you may be approaching a covenant breach. If a breach occurs, lenders may respond by increasing interest rates, restricting access to credit, requiring additional conditions, or taking other actions to protect their investment. Many business owners never carefully review the terms of their loan agreements and are surprised when financing becomes more difficult during challenging periods. Understanding covenant requirements helps you maintain stronger relationships with lenders and avoid unexpected financial restrictions. The 10th term is factoring versus invoice discounting. Both factoring and invoice discounting help businesses turn unpaid invoices into faster access to cash, but the way they work is different. With factoring, a company sells its outstanding invoices to a finance company. The finance company provides cash up front and then collects the payment directly from customers. With invoice discounting, a business uses its unpaid invoices as collateral to receive funding while still managing customer collections itself. For example, imagine your business has $200,000 in unpaid invoices. A factoring company might provide $160,000 up front and then collect the full invoice payments from your customers. With invoice discounting, a lender may also provide $160,000 based on those invoices, but your business remains responsible for collecting payments and repaying the lender once customers pay. Factoring can provide additional support with collections, but customers may become aware that a third party is involved. Invoice discounting is usually more private because the customer relationship stays directly with your business. Understanding the difference between these two financing options helps business owners choose the right way to improve cash flow while protecting their customer relationships.